1. Buy and hold, long-term investing, ideal for passive investors. The buy and hold approach involves purchasing stocks, often ETFs or blue-chip companies, and holding them for an extended period, regardless of market fluctuations. This strategy benefits from historical market growth and the power of compounding returns over time. To get started, open a brokerage account and use research tools such as Yahoo Finance or Morningstar to select your investments. An example might be investing in an S&P 500 ETF like SPY or VOO and keeping it for over 10 years. 2. Dollar cost averaging, DCA. This strategy suits those looking to minimize timing risk by investing a fixed dollar amount at regular intervals, irrespective of market prices. Dollar cost averaging helps avoid emotional decision-making by smoothing out the purchase cost over time. An example includes automatically investing $200 from each paycheck into a diversified index fund. 3. Swing trading, ideal for active beginners who have time to monitor markets. Swing trading involves buying stocks and holding them for days or weeks to capitalize on short-term price movements. Essential tools include charting software like TradingView and an understanding of technical indicators such as MACD, RSI, and moving averages. Traders often look for specific patterns like support/resistance levels or bullish candlestick formations. 4. ETF investing for low-maintenance diversification. ETF investing offers a straightforward route. You invest in exchange-traded funds, ETFs, that track specific sectors, indices, or themes. These funds spread your investment across multiple assets, reducing individual stock risk. 5. Dividend investing. This strategy is perfect for those seeking passive income streams. Dividend investing involves buying stocks with a robust history of dividend payouts and reinvesting these earnings to compound returns over time. This can provide a steady cash flow and includes companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble.